In this presentation, we will enter an adjusting entry related to depreciation within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. You can open the open windows by going to the view dropdown and open window list. We are going to do an adjusting entry for depreciation. In order to see how to do that, we're going to go to the reports dropdown up top, and we're going to go to the company and financial, looking first for the balance sheet standard. Selecting the balance sheet standard, we're going to change the date range within the custom report, and we will change that date range from 01/01/19 to 02/28/19. This is going to be our cutoff date at the end of February. So we want to make our adjusting entries as of the end of February. Now the depreciation is going to be like a very standard adjusting entry that we would expect to have to do at the end of any time period, either the end of the month as in the case here, or the end of the year. And it follows the pattern of most entries that are adjusting entries. Cash will not be involved. We'll have one balance sheet account and one income statement account. So now, to find the balance sheet accounts and income statement accounts are a little bit more tricky here, because depreciation actually has to do with furniture and equipment, or property, plant, and equipment. In our case, we have it grouped as furniture and equipment. So we're gonna make an adjustment to furniture and equipment, and it's called depreciation. And that's a little bit confusing. It's probably one of the more confusing adjustments that are there, and probably one of the better examples of what the accrual accounting is in terms of adjusting journal entries. And we can compare it to something like if we were to adjust something like supplies, or even inventory, where we could, if the inventory were on a periodic system, we could count the inventory and then reduce the inventory based on the physical count that we have. And when we do that, we would actually decrease inventory by crediting inventory, reducing inventory, and debiting the expense account cost of goods sold. We can imagine the same thing with supplies. We just expensed the supplies here, but if we had a lot of supplies, we would put them on the books as an asset, and they would accumulate upwards, and then we would count the supplies, determine how many have been used, and then we would decrease the supplies account on the asset account and record the expense. The other one we did this for is prepaid insurance, which we put on the balance sheet as insurance, prepaid insurance, and not expensing it. We determined how much of that insurance had been consumed, and then we wrote down the prepaid insurance here for the amount that had been consumed by debiting the insurance expense and crediting prepaid insurance. For the equipment, we'll do in essence the same thing. We bought equipment throughout the time period for $103,000. We are going to we're going to reduce some of that $103,000 because we consumed it. We consumed some of this equipment. And so we are going to do the same thing. We're going to debit an expense and credit the equipment account in a way. But the question is, why don't we just credit the equipment account? Why don't we just reduce the equipment account? In other words, if the equipment account went down in value, what is depreciation? Why don't we just say credit equipment, just as we did with the insurance, as we would with supplies or inventory? Why don't we use the account that we're actually talking about, which in this case would be furniture and equipment? And the reason is because it differs from some of these others in one way. In terms of equipment, in terms of inventory or supplies, we can actually see it physically decreasing. We can see it going down, and we can make a pretty good calculate. It's still an estimate of what the value, the dollar amount of that equipment is, or of that inventory or supplies are, or of this insurance. Insurance doesn't physically go down, but we can plainly see that the insurance policy covered has decreased because there's only 11 months left. So we know exactly what the calculation is and what the coverage will still be. Whereas the furniture and equipment, if we count it, it's still physically there. If it was a forklift, we still have one forklift. We know the forklift went down in value because that's typically what forklifts do over time, but we don't know how much it went down in value, and therefore it's more of an estimate for us here to say that this goes down in value. Because of that, we make up this other term called depreciation, and we use that to record the decrease in value. So instead of debiting equipment expense, we're going to debit depreciation expense for the equipment. Instead of crediting furniture and fixture, we're going to make up another account called accumulated depreciation for furniture and fixture. And it's going to be a funny account. It's going to be a contra asset account, meaning it's going to be up in this assets section, but it's going to have a negative amount there. It's going to decrease the assets. It's going to decrease the furniture and fixture. It's going to result in a net furniture and fixture amount being furniture and fixture minus that contra account. So that's what we're going to do here. Now, we're not going to get into a lot of detail in terms of how to calculate the furniture and fixture, because even if we have a few different pieces of furniture and fixture, it can get kind of complex to calculate it. There's at least 3 ways. We can use the straight line method, double declining method, and then we could use, there's some other methods, but we could use also the tax method to do this. And note that it's quite possible to have 2 methods that are used, meaning we could use some method that would make sense for bookkeeping, and then the tax code has their own methods that we would have to use for the tax code. So oftentimes, small businesses to mid-sized businesses will ask their tax preparer or their accountant, often who does the taxes as well, to just do the depreciation calculations for them and either provide them with just the tax depreciation. And if we do that, then we'll just record our depreciation in accordance with the tax code, which isn't as good because the tax code is not really designed to have the most accurate financial statements. It could be designed for other things. In other words, the tax code is there to incentivize the economy sometimes, and try to stimulate the economy, so they might accelerate or decelerate depreciation for other purposes other than financial statement reporting purposes. And therefore, for our purpose, for financial statement reporting purposes, the tax code depreciation may not be the best way to use. It wouldn't be what would be like recommended by most accounting standards because of the accelerated depreciation that's sometimes used in the tax code. So therefore, if it's significant and we want to track it, our information as properly as possible, we would end up with 2 depreciation schedules, one for our books and one for the taxes. But if we're a fairly small company and we don't want to do that, then we would probably ask our CPA to give us or our accountant at the end of the year to give us the tax depreciation and possibly just use the tax depreciation, or they can give us both. They can give us the tax and the books, and we can make adjustments periodically at the end of the year. Also note that depreciation will be a bit more complex because we probably don't have just one piece of equipment. We probably have multiple pieces of equipment, and we will need a subsidiary schedule listing out every piece of equipment and the depreciation related to it, so that if we sell any particular piece of equipment, we know how much has been depreciated for that piece. So actually tracking the equipment and the property, plant, and equipment can get quite complex because of the tracking of different pieces of equipment and the different types of methods that we must use, and at least being 2, typically the book method and the tax method, unless we use the tax method for the books. But just to give an example of the type of calculation that it would be we have the straight line method is what most depreciation methods are based off of. So we start with just the straight line method, which would be $103,000. That would be the amount if we had that as one piece of equipment. Then we're going to say that there's a residual value of $10,000, and that means that after the useful life is up, then we're still going to be able to sell it for scrap or whatever for $10,000. So we'll still be able to get $10,000 for it, even though it's been used up, and we're not going to be using it in the company after the useful life, which we're going to assume is 10 years. So we're going to say then we're going to subtract out here $10,000, and that leaves $93,000. So that means that over the life of this thing, 10 years, we want the accumulated depreciation to add up to $93,000, which will give us the book value of $103,000 minus $93,000, or $10,000, which we would believe will be the scrap value, the residual value of the equipment after that time. And then we're going to divide by the number of periods. So I usually think of it as years first. So if I divide by 10 years, because we think it's going to have a useful life, we're going to use this equipment for 10 years. That's going to be 9,300. That would be per year, depreciation per year. And we have consumed it now for 1 month. So I'm going to divide this by 12 months to get to, so if it's 9,300 per year divided by 12 would be 775 per month. So that's just an example of how we could get to a straight line depreciation. And again, we would have to apply that, basically that kind of example, to each piece of equipment and then add them together in practice to get to what the depreciation adjustment should be. Once we have that, the adjustment's pretty straightforward. It's always going to be the same. It's a little confusing to first think about, but it's always going to be a debit to depreciation expense and a credit to accumulated depreciation. So once you know the number, which we might just be able to get again from our tax preparer at the end of the year, then we could just enter that journal entry into our system. So to do that, it's an adjusting journal entry. We could go up top to the chart of accounts by going to banking drop down, use register, and then find the furniture and fixture. So we could find the furniture and fixture account here, or actually we want the depreciation related to the furniture and fixture, so accumulated depreciation. So I'm going to close that back out and go in there a different way. The traditional way we would do this is, of course, with a journal entry, meaning we would go to company dropdown, we would go to make journal entry, and we would debit depreciation expense and credit accumulated depreciation as of our cutoff date, in this case, the end of February. But we're going to try to use the registers. There's only 2 accounts here, so we could say, okay, we could try to use the registers. This one's a little bit tricky, however, because it's a contra asset account, which is a little funny. So we're going to close this back out. And then we're going to go to the lists up top, chart of accounts. And then we're going to find we can't use the equipment expense or the depreciation expense because that's an income statement account. It doesn't often have the same register type for the income statement account. So we want to use the other side, which is depreciation, accumulated depreciation. So here it is here. We didn't see it on the balance sheet because it's currently at 0. So we're going to double click on that. And here it is. Now the funny thing here is that this is a contra asset account. So it's a little bit difficult. It says increase and decrease, but it's a little confusing because does it mean increase the total assets, the normal asset balance, or does it mean increase the contra asset of accumulated depreciation, which is a contra asset account? So this is another area where they're really trying to help by having these registers, but I'm not sure it's easier or more difficult than working with the debits and credits, even if we don't know the debits and credits. But whether we use the debits and credits or this register, we can easily put this information in, and if it does the wrong thing, if it goes the wrong way, meaning if it adds to the equipment account instead of decreasing it, then we can go back in and fix it. So that's what we'll do here. We're going to say that's as of the end of the cutoff date, 02/28. That's our cutoff date. We don't really need anything here in the payee. And I'm going to guess that it's actually a decrease, which is, again, really kind of funny because it's really increasing a contra asset account, but it's decreasing assets in general because it has a balance that's unusual compared to normal assets. So I think it's actually a decrease, which is, again, it's kind of funny, but I'm pretty sure that's it. So we're going to try that one, and then and if it's wrong, we'll just go back in here and we'll flip it. And then the other side is going to go to the depreciation expense, and that's going to be down here, depreciation expense. And this company was set up with that when we entered the chart of accounts. So we didn't add the depreciation expense. We may want to give it more detail if we want to break out like equipment versus furniture and have depreciation expense dash equipment or something like that versus furniture, depreciation expense for the furniture. So we may want to give it more detail or something like that. We're using the defaults that were given to us when QuickBooks gave us the chart of accounts as we chose the merchandising company, and QuickBooks will almost always have depreciation included as one of the accounts. So I'll just type in there depreciation expense and it'll pick it up. Then we're going to say it's an adjusting entry for depreciation. Hopefully that's spelled close to right. And so we're going to say okay. Now it is a journal entry. If we double click on this journal entry, there's the journal entry. So this is a journal entry that, because there's no form that's going to be standardized to do this adjustment. So QuickBooks has to use a journal entry, which they'll kind of mask with that ledger. But here you see it's a debit to depreciation expense and a credit to accumulated depreciation. I'm going to copy this memo and put it here and save and close. We'll say, yep, close this back out, close this back out. So then here it is. So, and it looks like it's doing the right thing here. So notice it says negative 775, and that doesn't mean it's really, so it's decreasing the furniture and fixture. Also note that it's a little bit funny here because we would expect the reporting here to show the furniture and equipment first and the accumulated depreciation second, because this account only exists because of this account. In other words, this account could exist without this account. This account cannot exist without this account. So this should be up top. Why isn't it up top? Because they're both included as account types of fixed assets so that they're in the same grouping. And we didn't make account numbers, therefore it then defaulted to alphabetical order. So that's just kind of a default in the computer system, and the only way to really fix that is to use account numbers. But you got to be careful to use account numbers because you want to make sure that we're having the account numbers per section. Otherwise, our account numbers will be out of order as well. So you want to do some research if you want to do some account numbers in there, and make sure that you're spacing out the account numbers appropriately, using at least 4 to 5 digits probably to make sure that if your accounts grow, you have room to add more in between. So if I wanted to put more accounts in between here, I didn't just call it 15 and 16, because then I won't have room to put any more in there. And that we know how to order the account numbers by category, because it's still going to be ordered by these categories. So our account numbers have to conform to the categories. The categories do not conform to our account numbers. So we have the 103,000 minus the 775 means that we're saying it's the book value of 102,225. So that's the point here. This is why we couldn't record it just to the furniture and fixture, because we want to give our reader more information with this particular type of adjustment. We want to say, hey reader, this is what we bought it for. This is the cost. This is the estimated decrease in value. If it was a forklift, it's still 1 forklift or 5 forklifts or whatever it was. It's still those things. It didn't go away. We don't have a third of a forklift or anything like that. But we think the value of it has gone down, as is typically the case for furniture and fixture. We estimated that decrease by 775, and therefore the book value is now 102,225. If we look at the other side of this, we're going to go to the income statement or profit loss. Go into the reports up top. We're going to go down to the company and financial. We're looking at the profit and loss. Within the profit and loss, we're going to change the dates from 01/01/19 to 02/28/19. And here's our profit and loss. And once again, the expense is going up. This time the depreciation expense, bringing net income down again. And if we double click on this item, then there is our depreciation expense journal entry. And remember, anytime you see depreciation expense, closing this back out, you're thinking it's related to the equipment. So some type of property, plant, and equipment. That's what depreciation expense is. It's related to the equipment. Does not necessarily correlate to cash. And note that this is another area that if we had just expensed the equipment at the point of purchase, it would make 1 month look really bad. In other words, if we go back to this balance sheet and we said we bought $103,000 worth of equipment, let's say we paid cash for all of it. We didn't, but let's say we paid cash for all of it. If we did a pure cash method, we would just put that on the expense of equipment expense for $103,000, and that of course would make January look really bad compared to February. And so equipment's like an extreme example of why we have to use an accrual accounting. Even if someone used a cash basis, they would still probably put equipment on the books as an asset, even if they paid cash for it, because it would distort the books pretty substantially if we just wrote off the equipment when we purchased it, because this is supposed to be making money for us 10 years into the future. So what we have to do is allocate that investment over the time period for which it will help us to generate revenue, and that'll help us to gauge 1 month versus another month in relation to this piece of equipment. For more accounting information and accounting courses, visit our website at accountinginstruction.info.